Hey, good morning, everyone. Marty Mazzora here. It is the 22nd of March, 2026. Back from vacation. And although during vacation, regular blog readers noticed I did post, I think 2 or 3 times this last week as the market began to get dicey later in the week. So while I was away, I was able to stay pretty connected and aware of what was going on, and even communicated a change or two at the margin for the core portfolio as we continue to think through the current setup, the dynamics, and so forth, which is the definition of a fluid situation. On Friday, or after the close on Friday, or if it wasn't maybe early Saturday morning, the administration announced that it was preparing to step back military operations in the Middle East and to let the countries whose oil passes primarily through the strait to manage and get the strait open and protect their ships and so forth. The U.S. did say it would help in those endeavors as well. To, within a matter of hours, doing a complete 180 and announcing that Iran has 48 hours to open the Strait of Hormuz, or the U.S. is going to attack power plants in the country, starting with their largest. So that's going to expire, I guess, tomorrow evening, Monday sometime. And in the meantime, Iran has launched more missiles in the direction of Israel and has said there's no way that that's going to happen. And the retaliation will be severe if indeed it does, specifically toward energy infrastructure in the region. So definitely escalatory rhetoric, at least the latest. And it was interesting to watch the weekend markets. There's a platform that I can track I'll call it synthetic markets, where people bet on direction. And on the former news that the U.S. was going to begin to withdraw, markets had quite the rally. The Dow was up a few hundred points. The NASDAQ was up close to 1%. Oil was down a couple of percent. Gold was actually catching a little bit of a bid there as well. We're going to talk about gold fairly extensively here in a minute. But then on the latter news, with the 48-hour ultimatum, everything rolled over hard. The Dow, as I looked at least in that market, is down about 300 points, 200 to 300 points. NASDAQ down close to 1%, oil up 2%, gold down maybe 0.25% or so. Now, the last time we had a weekend like this, and these markets were pointing to a 200 or 300 point decline in the Dow, Monday opened with like a 900 point decline in the Dow. I don't know, obviously, what's going to happen tomorrow morning or between now and then, but that wouldn't surprise me based on the news. So, in addition to what I'm going to show you, and that's kind of running through the portfolio and how it's performed and what we expect going forward under different dynamics, we've actually been kind of pouring through scenarios using our new custom AI tool that's still under construction but is functional for us right now. And that's a very interesting endeavor that we've hired professionals to put together for us that is going to be very helpful. We're kind of excited about it. I may give you more detail on it as it develops over the next week or 3. But in the meantime, it also, one of the functions is it just pours through all of the global news and statistics and data and history and helps us think about probabilistic outcomes and then how we will be thinking about those possibilities and adjusting accordingly as things continue to develop. But in the meantime, and I think for today's discussion, I'm just going to start with going over notes that I've put in our internal chat. This always helps me keep on track and hopefully keeps me from rambling too much. And then we'll probably run through the usual charts very, very quickly. But I do want to spend some time on this. Again, working through all possible conflict scenarios. In terms of our core positioning, this is more or less where we stand at the moment. What's working, what's under pressure, and why. In a nutshell, the portfolio is behaving largely as designed. In terms of the current drawdown, the positions under pressure are under pressure for identifiable, thesis-consistent reasons. So to speak to that, the core allocation, which when I refer to that, I'm speaking of portfolios that are well over $100,000. That's still positive on the year. Now, U.S. stocks are down in the neighborhood of 5% year to date, down probably 8%, 8 or 9% from their peak. We are still actually in the green, albeit slightly, not nearly what we were 3 weeks ago, but significantly better than what the overall U.S. market has done. Smaller portfolios, more concentrated, they are either flat to slightly down, but considerably less than the overall U.S. market as well. Okay, so as for what's working, energy, which is the one area that the crisis is actually working for us, if you will. XLE is kind of the benchmark energy ETF. It's got all the big names there. Range Resources is actually an individual company in the nat gas space, and ENFR is an energy infrastructure company ETF. So it captures companies in that space. They're the clearest beneficiaries. When geopolitical risk concentrates around the Strait of Hormuz, the oil market responds directly and supply premium flows through to our energy positions. The three are up 6.1%, 3.29%, and 7.7% respectively since the start of the war. PDBA, which is our agriculture ETF, has traded higher by 3.1% during the conflict on supply disruption and food security risk, along with the fact that critical fertilizer inputs are shipped through the strait in meaningful volume. This injects meaningful input costs into farm production for the next planting cycle. That's definitely getting priced in here. So folks, this is where just broad-based diversification works. In addition to these macro-based positions, two of what I'll call our idiosyncratic plays have produced positive results as well. AT&T is up 1%. Delcath, which is a biotech company, is up 2% during the conflict. And then beyond the long equity positions that are working, there's what I'll call portfolio infrastructure, and that would be our cash position, which is now approximately 16%, and that's up after we cut exposure to emerging market debt recently. And that is in a Treasury money market fund that's still getting a decent yield, and that serves two purposes: reduces overall volatility and is essentially dry powder, earning a competitive yield while giving us the ability to act opportunistically when conditions warrant. This ultimately, as you know, clients, particularly long-term clients, ultimately becomes a buying opportunity. We just don't know when that ultimately ends up coming to fruition. We also hold put options on the S&P 500. This would be our left tail risk, or our tail hedges, if you will. The strike prices and expiries collaborate to protect against a severe drawdown. They are currently in play. They've had very nice percentage gains since this started, but again, they're designed to protect us against massive declines, as they did beautifully during the COVID situation, for example. And since then, even during 2022, we saw a single-digit drawdown when the broader averages were down, 20+%, 30% peak to trough, folks. And that was fairly recently. That was just in 2022. As for what's not working, and this is where I want to dig into gold for many of you. This is a surprise, I know, to a lot of people. So gold has not functioned as a geopolitical hedge during the conflict. In fact, a friend of mine said to me yesterday, the reason I know this Iran situation isn't for real is because gold isn't responding, or worse to that effect. And I appreciate that. And that comes from, someone who's probably a very smart investor, but thinks of gold in somewhat of a single-dimensioned fashion, which really isn't the way to think about gold. So why isn't it working? When a conflict simultaneously pushes energy prices higher and creates economic uncertainty, it essentially produces a stagflationary environment, i.e. the U.S. dollar tends to strengthen. Investors around the world seek the dollar as a safe haven, which is a separate impulse from seeking gold. A stronger dollar creates a direct headwind for gold priced in dollars because they move in opposite directions by design. Now, that's kind of textbook, if you will, and I put that in there anyway. The gold is not really trading along textbook lines, if you will. There have been days when the gold saw a nice rally during this, while the dollar rallied as well. So what's more meaningful right here is that gold has been trading most closely with real interest rates. And that's the difference between nominal rates, what the actual interest rate is, and inflation. So you take the nominal rate and you subtract the inflation rate, And that gives you the real rate, or in other words, the inflation-adjusted return on U.S. Treasuries. So when real rates rise, which they have been of late, and as the Federal Reserve maintains a hawkish posture, definitely Fed funds futures are suggesting that, gold faces a severe opportunity headwind or opportunity cost headwind, regardless of what the dollar is doing. The result is that gold has two significant forces working against it simultaneously. While the forces that would normally lift it, dollar weakness, rate cuts, pure fear-driven buying, are either absent or being overwhelmed. Also, and this has clearly been the case, and we've talked about this early on in this crisis, is when markets shift into genuine risk-off mode, gold frequently sells off alongside equities, a dynamic that confounds investors, along with what I just mentioned, who hold it specifically as a safe haven. It's pretty straightforward. Institutional portfolios running significant leverage receive margin calls when their equity and risk asset positions move against them sharply. To meet these calls quickly, they sell what they can, and gold is the one thing that's getting a bid, and it's been hugely profitable for them. And so it fits that description precisely. It's not that gold's safe haven properties have disappeared, it's that it becomes the funding source for forced deleveraging elsewhere in the portfolio. The same dynamic played out vividly in 2020 when gold sold off sharply in the initial COVID crash, despite being in a multi-year bull market. So we're looking kind of at that again, only to recover strongly once the forced selling exhausted itself. What looks like gold failing in a crisis is simply gold being used as an ATM by institutions that have no other clean exit. So, folks, what really hasn't changed is the structural case for gold. As a dollar hedge, which is kind of the fundamental backdrop for our long-term bullish thesis, the thesis is anything but broken. The timing is simply working against us in this specific configuration. When the dollar eventually reverses, and it will, and the forces that drive that reversal are durable, gold will be among the first beneficiaries. Thus, we're holding on to our position right here. I would go so far to say that if it continues to decline, it'd have to go quite a bit further. We'd probably be buying more. Now, also, we do have a hedge on gold, and we're getting pretty close to our strike price. Also, what hasn't been working is international developed and emerging market equities. And so this is thesis consistent volatility for sure. So and those positions are, across the Eurozone, Japan, other parts of Asia, South Africa, Brazil, Chile, and Mexico, and broader emerging markets as well. In a risk-off environment driven by geopolitical stress, international and emerging market equities typically see sharper short-term drawdowns than U.S. large-cap stocks. It's mechanical. Global investors reduce risk by selling the assets further from their home base first, which is not a reflection of poor fundamentals in those markets. Plus, foreign equities have experienced significant gains over the past year. Plus, profit-taking amid the uncertainty makes sense. And note, valuations still remain historically compelling versus U.S. equities, despite their notable outperformance over the last year plus. So what remains true about these positions? Our South Africa position in particular is very compelling. Gold miners operate with costs denominated in South African rand, while their revenues are priced in U.S. dollars. At current gold prices, their operating margins are literally at or near historic highs, even while the gold price itself is struggling. This is a position we're watching carefully for potentially an opportunity to add. We would not reduce that right here. Our Brazil and Chile positions are commodity exporting economies. I talked about this early in this crisis, in that intuitively you might think they would rise here. But when this current conflict resolves and the demand destruction overhang on industrial metals lifts, these have significant recovery potential. In fact, during the relief rallies, when we got rhetoric that said this may be over, these areas are where we saw the strongest rallies. So I expect that when this does begin to resolve for good, we will see quite the catch-up in some of these areas that have been taking what I would call outsized hits relative to what you would have expected. Europe and Japan, structurally undervalued. They remain so relative to U.S. equities on virtually every fundamental measure. They are definitely feeling the conflict because they are oil consumers, not oil producers. Big changes in Japan structurally in terms of corporate governance, government policy and so forth. In Europe, we know that finally, after a lot of years of not enough, there's massive fiscal spending going on in the Eurozone, ultimately very bullish. This whole Iran conflict just throws at least a short-term dose of uncertainty into what were really good fundamental setups coming into this year. As you can tell, we're certainly not interested in abandoning these positions right here, but we are open-minded and flexible. So if this thing continues and there's no end in sight, we're going to have to make some adjustments in some of these. In terms of the U.S. market, our U.S. positions are performing in differentiated ways, which is exactly what diversification or selective construction is supposed to produce. That said, the overall U.S. equity market response to the crisis has been pretty much across the board negative, with tech and financials, which we actually added to along the way here already, holding up best. In fact, this last week we added a little more to financials. There has been an announcement of reduced reserve requirements, which frees up a lot of cash for lending and stock buybacks and dividends and all these things. And if these interest rates are going to stay elevated, that's going to be good for interest rate differentials. There is stress in the financial market. It showed up this weekend when I tested our financial stress index, but not to the point that we think financials are not a compelling buy right here. So we've upped our allocation there, and it's actually held up pretty good. There was a day last week, I think Wednesday, when everything was crashing down. Our financials position was actually in the positive. So we like that and have pretty strong conviction there going forward. But again, we'll keep an open mind. Ultimately, when this conflict moves toward resolution, and based on everything we're observing in diplomatic channels and market behavior, the pressure toward resolution is building. Several things will likely happen in relatively quick succession. So here I just talked about escalation, but the more this escalates and the more dire the consequences of these threats are, the more pressure there's going to be on a resolution. And I suspect, in fact, I would bet real money that as I speak at you, the powers that be, either through Middle Eastern channels or what have you, are talking about how they can come to some resolution without having to resort to even more extreme measures. Now, those measures look like they're on the table, so it doesn't mean that's not going to happen. But make no mistake, there are talks going on as I speak. So, again, several things will likely happen in relatively quick succession on resolution. The safe haven dollar bid will fade, and real interest rates will ease as the inflation shock dissipates. Risk appetite will definitely return globally, and the positions in this portfolio have been under the most pressure, yada yada, which is what I just said, will likely see the best results. There's more I could get into on that, but I think that gives you a pretty broad brush. Again, we're pleased to still be in our larger core construction, still positive, albeit slightly on the year, flat to slightly negative on our smaller portfolio allocations. So folks, again, in the grand scheme of things, what we've been through together with most of you clients over the years, this is amazingly muted relative to the potential that this crisis holds for the global economy. So stay tuned there. Okay, so as for the charts, the S&P 500 one-year daily chart, I'm just going to do this quickly because I rambled quite a bit there. But I remember when we were up in here in this consolidation range, I said that, break of the 50-day moving average, and ultimately a break of this range is technically significant. I figured we'd find support at the 200-day moving average. We really have not. We've just crashed right through that with all the news. And right now we're finding support at the lows back from November of last year, and prior to that, September of last year. So we're getting further off of the all-time highs as we go. And there's really nothing in the momentum charts here that says, this is a time to be accumulating stocks, right? And again, lots of other technical ways we can look at it, but these are the basics that we really trust and respect. I will say this, though, that even though we don't have bullish divergences, we are now technically oversold on the S&P for the first time since April of last year. And you can see that marked the bottom of that 21% intraday decline, and then we were off to the races. So we'll see. Now, so technically, you'd begin looking here. If you're brave, you might even put on some positions here. But right now, the news and the momentum would tell you maybe not. But again, that can change literally with a tweet. As for the NASDAQ 100 index, again, broken down below the shorter term support of the 20-day moving average, now becomes resistance, now breaking down below the very technically significant 200-day moving average. Is still upward sloping, which is positive, but the 50-day has rolled over, and we are now piercing the support levels that go back to when they were resistance right back here, all the way back to August of last year, and have been support ever since. And then when we look at the momentum indicators, sell signal on the MACD, not quite oversold on the RSI just yet. As for yields, wow. So here we have geopolitical crisis, which typically you see money rush to treasuries. The nature of this crisis has people selling treasuries, and as a 10-year yield up at a place it has not been since the summer of last year, and that is playing havoc, of course, with risk assets and with sentiment going forward, and with the Fed and what they're thinking about in terms of whether they should be focusing on the economic dynamics of these higher oil prices or the inflation dynamics. And then the dollar has seen quite the rally, come off a little bit here this last week, rallied on Friday. Higher yields support the dollar, and it has been getting the safe haven flow during the crisis as well. And then gold has broken down here below the 50-day moving average, which is now flattening out. We've now seen about a 19% decline. Remember that spot gold monthly chart that I showed you several times over the last few months being in massive overbought territory, and I told you we never get out of that without a double-digit decline, and I felt strongly about that, and that was before the Iranian war began. So technically gold was due for something. You see these nice big gaps here. This will get filled. Ultimately, you'll see gold come back and fill these gaps. But I think right now, the way it's trading, either we have to get even more dire news out of the Middle East conflict that will finally have gold being the safe haven bid, or the reverse of that, and you have real rates drop, and then gold gets right back and catches that bid. I think people will rush to gold fairly quickly if that dynamic changes. And so unequivocally, this is not something we want to abandon because of this, but it is something, as I've told you, we did put a put hedge underneath, and we're getting close to our strike price. So we don't have much more downside in our portfolio as a result of gold going down. So that's good because this has impacted our relative performance. But ultimately, we remain structural bulls on gold. So folks, I am going to do a hard stop right there. Obviously, I'm going to communicate with you more than usual over the coming weeks as this situation continues to unfold. Thank you as always for watching and listening. Hope you have a great rest of your day. Talk to you soon. Bye-bye.